Bytedance has evolved rapidly from its 2012 roots as a news aggregator. Today, its e-commerce and advertising divisions, led by TikTok and the Chinese app Douyin, form a global social media powerhouse that generates billions in revenue. This is the icon for Daobao, the company's 2023 chatbot. It occupies the same consumer niche as ChatGPT, but in China, it has already become the most popular AI application on the market. This chart illustrates the financial mismatch created by the company's success. While its reach expanded, Bytedance's private market valuation plummeted to under $300 billion last year, a fraction of the earnings multiples commanded by its rivals in Silicon Valley. The gap remains even when we compare Bytedance to its domestic peers. Adding Tencent and Alibaba to the chart shows that Bytedance was trading at a severe discount compared to older, slower-growing Chinese tech giants. British investor Fred Blackford saw this pricing as an irrational mistake. Through his firm Future Positive Global, he began quietly hunting for Bytedance stock, eventually building a massive $500 million stake. Blackford's thesis was built on a simple observation. A high-growth AI giant was trading at what he called a cigar butt price. He bet that the company's fundamentals would eventually outlast the political panic that was driving American investors to flee. To understand why that valuation dropped, we have to look toward the U.S. Capitol. The fire sale had nothing to do with Bytedance's profit margins. It was the result of a coordinated campaign by Washington to curb their influence. Bipartisan pressure created a toxic environment for investors. The Trump administration threatened a forced sale of TikTok, while the Biden administration issued executive orders preventing U.S. funds from investing in Chinese companies involved in sensitive technologies. This is a semiconductor fabrication facility. By blockading the high-end chips produced in environments like this, the U.S. attempted to starve Bytedance of the hardware required to run its massive AI models. The strategy worked, not by destroying Bytedance, but by terrifying its investors. American venture funds, facing legal hurdles and political scrutiny, began liquidating their Chinese holdings as quickly as possible. This mass exodus created a forced seller environment. When major funds dumped assets out of geopolitical fear, they leave behind an artificial vacuum that international capital can exploit at a steep discount. Acquiring $500 million of Bytedance stock was a logistical grind. Because the company is private and wasn't issuing new shares, Blackford couldn't simply buy into the business through an exchange. He spent months consulting overseas experts like James Anderson and Li Lu to validate the company's long-term sustainability. He needed to be certain the business could survive the political crossfire before committing his syndicate's capital. This flowchart tracks how he found the stock. He had to reverse engineer the ownership of major venture funds to identify the specific limited partners who had backed Bytedance years ago and were now desperate for an exit. Once identified, he reached out to these partners directly. He offered them a fast cash exit from a politically sensitive asset, bypassing public markets to extract shares from dozens of different transactions. Executing a trade of this size required more than just capital. It required a process of cold calling and networking to find liquidity in the shadows of the private market, where most investors were afraid to look. The financial payoff arrived quickly. Since Blackford began buying those discarded shares last year, Bytedance's valuation has rebounded to nearly $600 billion, doubling his syndicate's initial entry price. The trade was built on a disciplined investment philosophy. The belief that a career only offers a few moments where a market is so irrationally priced that you can buy a global leader at a fraction of its worth. This is Warren Buffett, who popularized the punch card theory of investing. He suggests that if you only had 20 opportunities in your life to make a major move, you would wait for the rare moment when a high-quality business is trading at a massive, unearned discount. Blackford acknowledges the persistent risk of holding Chinese tech during a period of strained relations, but his firm remains a net buyer, betting that the price is still fair compared to the company's actual earning power. The U.S.-China tech war has effectively distorted global capital markets. By driving American investors out of high-growth companies, the geopolitical standoff created a once-in-a-lifetime arbitrage opportunity for those willing to ignore the political noise.